Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Cincinnati. Welcome to the show, John Casmon.
Hey, Victor. Thank you for having me.
Great to have you here. Now, John, you're based in Cincinnati. You've been at this game a while, and I'm excited to get an update on your strategy because it has shifted. But maybe before we dive into the details, perhaps give a little bit of your backstory and how you got to this point in your journey.
Yeah, man. So I'm also a podcast host myself. My show's called Multifamily Insights. We've been doing that for, I don't know, about maybe 8 or 9 years now. And I've had the pleasure of talking to a lot of great individuals. Not you yet, so I'm excited to get you back on the show as well. But I've been investing in multifamily apartments for about 12 years now. Started off with a duplex and house hacked and slowly started to build my portfolio, learned about, working with other people's money and raising capital. And I've been doing syndications for, like I said, about 10, 12 years now. And that has changed dramatically, especially over the last few years, where the rising cost of interest rates have shifted. The profitability on some of these deals used to be, pretty much every deal worked out and people made money. And now most deals are, maybe not living up to expectations. And we've been fortunate enough to have most of our deals pan out, especially our local deals. And we have shifted our approach. We really think the opportunity in the market today is buying local, and that may feel like a no crap Sherlock situation. But again, I think right now, the more you can control, the tighter you are with your operations in your market, the better off you are. So that's our focus right now, and we can dive into a little bit of that more. But our focus is really trying to control what we can't control in our backyard.
Absolutely. Of course, there's many different factors. There's macro factors. There's things like capital costs, obviously, which is, if not the number one, it's certainly within the top two in terms of overall costs. And then, of course, real estate is hyper-local. Through the pandemic, a lot of people just relied on the rising tide to lift all boats because virtually every market went up and to the right. And so it was easy to make money, like you said. And today, that's not necessarily true. Cincinnati as a market is, I wouldn't say that it's growing dramatically. It might even be just kind of going sideways. To what an extent is population growth core, in your opinion, to having that sustained excess of demand and shortage of supply?
I think it's critical. And, to your point, it's a market that we love and we've loved it for a number of years. And it hasn't shifted much. And I think that's the story. Very often as investors, we want to ride the wave. We want to go to markets that are trending upwards, right? Run into Phoenix when we're seeing double-digit growth. And that's awesome. But when you see that growth, you got to understand what's on the other side of that. And Cincinnati, the Midwest as a whole, but Cincinnati in particular, you're not going to get the highs. You're not also not going to get the same lows. So for us, it's a steady market. And as investors, steady means more predictable. It's not to mean that everything is going to be easy, but we want to remove as much risk as we can. And understanding the market dynamics makes it a little bit more of a fairer game as far as what we can expect. Certainly, we all have to deal with rising interest rates. We all have to deal with some of the economic challenges that happen. But we understand the demand in our market. Cincinnati is never going to see a year of double-digit population growth or anything crazy there. But the people who live here want to live here. They're here because they grew up here. They got family here. They went to school here. They come back because maybe they went to, Chicago or Ohio State or some other place, and now they want to come home and raise their family, right? So people are here because they want to be here. It's not like they're chasing high tech jobs or high paying tech jobs, and then if something happens to those jobs, now they don't want to live there, right? So for us, we like that aspect of it. It is growing. It's growing, slow but steadily. And that is something where we can kind of see what's happening in the market. And again, we can take it to the next level. Very often, investors, you want to focus on that surface level research, but really the juice is really in that next level, right? Understanding the sub-market data, understanding what the city and what the region is looking for, understanding where the infrastructure is being developed. When you understand that and you can, get really close and nuanced with where that development is taking place, I think that's where the opportunity lies.
Now, when you focus on multifamily apartments, are you segmenting the market further in terms of, is this workforce housing? Are you going after more of the luxury segment? When I have conversations with investors and sometimes even tenants' rights groups who say, well, we need more affordable housing. Well, affordability is a function. It doesn't matter who owns it. It's a function of what does it cost to build something. I don't care what the finishes are. That's just the thickness of the icing on top. The core cost is what it is, and so at a certain point, the only choice becomes either to buy older products, so you're buying it with last year's dollars that have been devalued to some extent, or you really have not much choice but to go at the higher end of the market.
Yeah, it's a great point, right? So I think part of what we have seen is there's great opportunities when you're local. When you're not local, you kind of have to have a really crystallized investing strategy. And certainly we have that, right? Our thesis has not really shifted much over the last 10 years. We like B class value add apartments. With that said, I can say that to 10 different people and you could get 10 different interpretations of what that
Sure,
means.
sure.
So for us, when we talk about B class, we're talking stuff that's built in the 80s, the 90s, the 2000s. If it's an older project, then we want to see some of the upgrades being made, particularly to the infrastructure, right? To the plumbing, to the electrical, to the roofs. So we want to go in and really focus on the value add component, not saving an old infrastructure project where we're going to put a lot of money into things that don't drive the rents. When you talk about affordable housing, again, that's another thing that a lot of people can interpret differently. There's a difference between low income housing. There's a difference between government-backed properties versus simply having workforce housing that's available. And the workforce is not the same as affordable. So to understand these nuances for us, we want to live in places and own in places where people pay their rent. It is workforce housing. It's housing that is desired. So we are not necessarily relying on government grants or handouts necessarily. We're focused on areas where people want to live. These are blue collar workers. It's the backbone of America. The teachers, the firefighters, police officers. These are the people who service this country. Those are the ones who keep this place going. We want to provide quality housing for these individuals. So that's kind of our focus. Now, whether that is the 1985 built 150 unit apartment complex or that's a 2020s built 8 unit apartment building, we want to have the flexibility to invest in the right opportunities based on the business plan that presents itself.
I often have the conversation with folks that are looking to add value to existing, and of course, as you know, you can get Excel to lie to you many different ways, and you might come up with a thesis that says, I don't know, we're going to add washers and dryers to the units, and that'll drive an extra $50 a month in rent, and so you make the investment. And it doesn't always play out the way you planned. What's that experience been like for you? Have you ended up with some stranded improvements, or how do you make those decisions?
You're spot on, right? And it's funny you said the washer and dryer because that's exactly what we had on one of our projects. We bought a property out in Louisville, 104 units. We planned on adding washer and dryers to it. Well, guess what? We found out as we did our deeper research that most of the people own their washer and dryers, which was different than what we saw in Cincinnati, right? I know a lot of times we think these Midwest markets are very similar, but in Cincinnati, that's not the case. In Louisville, it is. Most of those people buy and they just move with their washer and dryers. So we thought we'd have higher adoptance or higher acceptance there, and that just wasn't the case. So as we decided and looked at all the numbers, we actually just realized that, you know what, the return on the investment's not there. We're going to spend $1,000 putting in washer and dryers to make $50. And what we actually found was a better investment. And that's part of, I think, your job as an investor, right? You really have to be an entrepreneur. And too many of us are thinking about it based on that spreadsheet and making those numbers line up to say, okay, we can get this, IR 15% IRR or whatever it is. But the reality is you got to find opportunities, right? You got to solve problems. And in this case, we knew we wanted to make the properties a little bit nicer. And the way we were able to do that is actually through backsplashes. We're able to just do some very selective upgrades, adding a backsplash. Well, the backsplash cost us a few $100s to put in, but it actually generated a $65 rent premium because it looked newer, right? It looked great in the pictures. It felt more elegant for the residents. So that was something that we did and had a greater return on investment than we ever underwrote into our plan. So I think part of it is as investors, you go in certainly with a business plan, but you have to step back and ask yourself, does this actually make sense? Is the market buying what I'm selling, or do I need to pivot? And where else can I create value? You don't want to just invest in something because you put it onto a spreadsheet if it's not going to deliver the ROI that you're anticipating. Oftentimes, there are smarter investments that we can make, but we have to have our return metrics. I don't know about many of your investors. One thing we like to do is when we make those improvements, we will test it and we'll see, okay, what are we actually getting? Are we getting the rent bumps we expected? Are we getting the feedback from residents that this is something they're looking for, or is there something different? And we can always pivot after we go through a couple of unit changes to understand what the market is really looking for and adjust our business plan accordingly.
a lot of older properties are lacking the infrastructure to install some of the latest technology, whether it's smart building features, facial recognition at the entry doorways, all those sorts of things. And yet, if you can provide that in, say, a 1980s or 1990s building, it really changes the resident's perception that they're living in a modern property because it has modern features. Have you experimented with retrofitting that? And how's that? If so, how's that gone?
Not as much, partly because though, when rents were going up so fast over the last few years, you didn't have to do any of that stuff, right?
Right.
So for us, it makes sense to make the investments. Some of those things are great, but the ROI is still kind of up in the air for some of these properties. And ultimately, I think we have to understand what are people going to pay for? What do they really, really want? Some of those features are really cool. We had a property where we did a smart package, right? We did smart locks and smart sensors and all these different things, right? Smart lights, and you could turn them off when you were away. And that was great, but we kind of forced people to pay for that. And that was we got some pushback from some of the residents who were like, that's cool, but I don't think it's worth what you're charging me for, right? So I think this comes back to understanding your audience. When you're talking about teachers and you're talking about post office workers, yeah, that's cool, but are they going to pay a premium for that? Or do they really just want a quality unit? Do they want it to look clean? Do they want the countertops to look nice? Is it a place where they feel great inviting their friends? If you're doing a larger complex, then I think some of that makes sense, right? If you got a 300 unit building, then it makes sense if you've got a swimming pool and other amenities. But when you're, kind of that 100 unit and less range, you want to be really mindful. And I think the more important thing is the living space itself. Make sure it's a quality living space that someone wants to live in, and then you can start to focus on some of those additional features.
Love it. Well, John, if folks want to connect, if they want to learn more, what's the best way?
Yeah, listen, two things. One, we've got our podcast, Multifamily Insights. If you like this shot of espresso, maybe want to go a little bit longer. Our typical episodes are about 30 to 40 minutes. Check out that podcast anywhere you listen to podcasts. But then also, I've got a free guide. If you are looking to scale your portfolio, if you have questions and just trying to be a better investor, it's 7 questions you must ask before investing in apartments. I have found that it's not really about the deal versus people missing out on asking the right questions. Some of these questions are questions you're asking yourself, because if you've never done apartment syndications or you've never developed a property, but you're going to do that next, you usually aren't that critical on yourself, right? You're critical on other people, but not yourself. Ask the right questions. Sometimes you got to ask them of yourself. Sometimes you have to ask it of your team, the market, the opportunity. This is 7 questions you must ask before investing in apartments. You can get that on our website, casmoncapital.com/7 questions.
John, this is great. For the listeners at home, you definitely want to connect with John Casmon at casmoncapital.com, as well as check out his podcast, Multifamily Insights. And definitely from his website, go download his 7 questions guide at casmoncapital.com/7 questions. The links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.